Hello everybody, welcome to episode 7 of M&A Demystified. In the previous episode, we talked about the sources of financing and financing a deal, and in today's episode, we are going to talk about structuring a transaction. So let's get started. Structuring a transaction, that is, determining what legal and financial form the entity will take, is one of the most challenging aspects of a deal. It is usually driven by tax, legal, and accounting considerations. There are three general forms used to structure a transaction. 1. Asset purchase, 2. Stock purchase, and 3. Statutory merger. So what is an asset purchase? It is where a buyer can purchase some or all of the assets of the target. The buyer also has the advantage of being able to pick the liabilities that it wants to acquire, with certain exceptions. So when is an asset purchase necessary? If the sale involves only part of the business that is owned by the seller, or if it involves selling a product line or a division that is not run as a subsidiary and hence does not have its own books and records. In those cases, asset sale becomes the only option. So when is an asset purchase desirable? When the purchase price is greater than the tax basis of the assets. Tax basis is nothing but the value at which the assets are carried on the tax balance sheet of the target. So let's say the assets on the tax balance sheet are at $100 and you as a buyer are paying $200 purchase price. So, and the transaction is structured as an asset purchase. Two things happen. 1. The buyer gets to record the assets on its books at $200. So what is the advantage of that? Buyer will get greater depreciation or amortization deductions, which will allow them to pay less tax in the future. And if the buyer decides to sell these assets again, the gain on sale will be less and there will be lower tax. So it's a big tax advantage to the buyer to be able to record assets on a stepped up basis. Now, if you look at the seller side though, they have now a gain on sale of $100, which is the difference between the purchase price and the assets on its books, and they have to pay tax on the $100. So it is what is best for the buyer is not always good for the seller, and as such, during negotiations, seller may want to have some of that compensated through a higher purchase price. So when is asset purchase not possible? Since an asset purchase involves legal transfer of each asset, it could be very costly or not feasible in certain industries. For example, in wholesale distribution, there could be hundreds of exclusive agreements, and preparing all of those contracts could be very costly. In oil and gas industry, each pipeline might have numerous permits and land rights, and transferring all of those could be very complicated. And some businesses could have local licenses where transfer of ownership could be a very lengthy process as well. And if there are several leases, they might not be assignable without the consent of the other party. So for these reasons, it is important to understand all the legal arrangements of the business to see if asset purchase is feasible. The alternative transaction structure is a stock purchase. A stock purchase is where buyer purchases the stock of the target in exchange for cash or its own stock. In a stock purchase, the buyer acquires all the assets, all the liabilities, and all the tax attributes of the target. Since buyer has to acquire all liabilities, it might seem like a disadvantage, but usually the buyer will negotiate indemnification against any undisclosed liabilities while negotiating an acquisition agreement. So when is a stock purchase appropriate? When the transfer of assets is either too costly or time consuming, a stock purchase is better. Or if the target has net operating losses or NOLs that can be used to offset the taxable income of the buyer, thereby reducing the taxes in the future, stock purchase could be used. However, to avoid companies just buying loss-making companies to reduce their own taxes, there are certain limitations under Section 382, which limits the NOL deductions that a company can make in a given year. What are some of the disadvantages of a stock purchase? It requires shareholder approval and could be difficult to complete if there are several shareholders and even if one of them refuses. Also, the assets come over at whatever tax basis they are on the target's books. Meaning, if the assets on the target's books are at $100, they come over at $100 even though the purchase price is at $200. So you don't get any step up or the tax benefits that come with it. However, under Section 338 of IRC, it is possible to make an election to treat it as an asset purchase for federal tax purposes. The third alternative is a statutory merger. It is a transaction in which one company is legally absorbed into another company. Here there is no independent transfer of assets or liabilities. Entire transfer occurs when a merger certificate is filed with the state authorities. There are several types of mergers called forward merger, reverse merger, or a subsidiary merger, depending on which is going to be the surviving entity. So what are some of the advantages of a statutory merger? It is simpler than a stock purchase. It is generally approved by board of directors and a majority of stockholders and does not depend on reaching an agreement with each individual shareholder. So in this episode, we talked about the 3 general forms used to structure transactions. In the next episode, we are going to talk about the appropriate legal entity structure for the acquired company. Thanks so much for tuning in and have a great week until we meet next.